Hey, okay, back again for February's edition of Keeping Current Matters. And what I think this month I'm going to focus on inflation, right? Rates and the forbearance program again, because I feel like those are still are going to be three hot topics that are going to be on most of your all's minds today, or what you have questions over. So hopefully we can answer some of those for you all, right? So the big thing I want to talk about is home ownership as a hedge against inflation, right? So inflation is probably not a surprise to anyone, right? I think we all see it, and so it's not going to come as a shock that we're experiencing inflation right now. But we'll go to Mark Houston from Investopedia, where he says real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So we are, of course, seeing that inflation's playing a part of it. Supply and demand is playing a part of it. So it's nice to get that benefit of inflation, right? But then also our monthly housing payment is probably what most people spend the majority of their income on every month. You know, it's going to be the largest expense that homeowners are not homeowners, just people across the board. So whether you're paying a rent or mortgage, that's going to be your biggest income chunk every month. But you will see home price appreciation tends to outpace inflation, right? So we'll see, going back to the 70s, comparing inflation to home price appreciation. 70s, 80s, right there neck and neck. 90s, it's always home price appreciation is up there to, offset the inflation prices. 2000s, of course, we know what happened there. Certainly an oversupply of houses. Values not true to where they should have been, right? Lending practices, we'll say not ethical, to say the least, right? A little shady. But then 2010s, 2020s, we bounce right back up to what we're used to, right? 2021, of course, where home prices are crushing the scene. Always nice to see that. We'll move on to James Royal from Bankrate. He says a fixed rate mortgage allows you to maintain the biggest portion of housing expense at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting. And those of you who are renting, I'm sure you are feeling that I'm sure you're at home nodding your head, right? Rental prices are increasing, as they typically do every year, whether we're in inflationary times or not, right? So it's nice to be able to own your home, own that mortgage payment, and have that be something steady, right? There's not a guess, like, is the landlord raising the rent? What's going on with that? So it's always nice to have that constant. And this chart just goes on to show how rental price appreciation compares to core inflation rate. And it's typically going to be always higher. Sure, it's going to tick down a little bit here and there, but for the most part, across the board, across the decades, because this goes back to the 1970s, the rental price appreciation is always going to be higher than core inflation rate. No way to get around it, right? Natalie Campisi from Forbes, not Mad Magazine, right? I didn't do the proper research before before I said I do. Dang it. But no, so Natalie says homeowners are shielded from mounting rental prices because their cost is fixed. Regardless of what's happening in the market, tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. So if homeownership is on your radar, if you're thinking about it in any capacity, now's the time to sit down, reach out to me, and we can chat and see if it makes sense for you, because now is going to be a great time to buy a house. And this chart I always like. So this is from Home Price Expectation Survey. So they get a group of 100 like economists, data analysts, just to get their take on where they think home price appreciation is going to go in the future. So, and this was in the last quarter of 2021, where they thought that they were going to see home prices go the next 4 years out to 2026. And you'll see, and they divide them up. So those who are more optimistic and rose-colored glasses, where do they think home price appreciation is going to be? And then, those who are a little bit more cautious, the Debbie Downers. Sorry, all y'all Debbies out there, but just the folks who tend to see a little bit more risks, hurdles to jump over. But I mean, even those folks are saying 23.7%. So, almost 24% price appreciation over the next 4 years, which is always good. We'll take that. We'd love to see that 62, but we'll take 24%. That's nice. Moving on to mortgage rates, right? So I know these, is it only Monday? Oh gosh. Okay, so these past couple days, right, overseas, might have some of us holding your breath a little bit, but we'll start off on a more positive note with Sam Cater from Freddie Mac. He's saying the economy lost some momentum in January, leaving mortgage rates unchanged from last week and relatively flat for the third consecutive week. Again, this was at the beginning of February too, that he said this. This stagnation reflects the economic impact on the Omicron variant of COVID, which we believe will subside in the coming months. And as economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated and supply remains low, driving higher home prices. So yes, they are. All experts are projecting home rate or interest rates to increase. Right now we're about around 3.55%. It is going to slow down a little bit right now with all the uncertainty going on overseas. So also, if you're thinking about buying, it would be now would be a good time while it's a little uneasy over there, right? But hanging around 3.55% now. We had a good jobs report earlier this month, so that tends to let help the feds raise their rates a little bit. Now, of course, mortgage rates are not tied to the Fed rate, but the Fed rate does have a big influence on the rates. So, but still, overseas is gonna give us a little bit of a breathing like a little bit of a break right now until we figure out what's going on over there. But now if we check out this chart, so this chart is the start of the pandemic, and you'll see that we're around 3.7% for the interest rate. Of course, we dip down when we're in the thick of things, and then we're right now at 3.55%. So about where we were when we started. So So when you hear that the rates are rising, don't get too panicked, right? Because we're still right back where we were going forward. And then here, if we take it all the way back to 2018, you'll see that 3.55% looks pretty nice when compared to the 4.5% and almost 5% that we saw in previous years. So again, don't let it scare you. Just it's just to inform you that yes, they're gonna start ticking up, but really no economists or experts are seeing it jump, into the fives this year. Now, Sam Cater again. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper just a little. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. So, I mean, it's still going to be an issue of supply and demand that we're going to see. That will keep mortgage or home buying a little on the low side. It's not stopping it by any means, but inventory is always gonna cause an issue for us. And he goes on to say, in 2022, we expect purchase originations. So that's home buyers. Purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while the refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. So with this, if you see any news reports that cause concern for you that the mortgage industry is shrinking or slowing, or home buyers are not there because the numbers are decreasing, it's not going to be home buyers. It's going to be that the refinance market shrinking. Okay, so don't think that you've missed the boat to sell your house because the buyers aren't out there. That's not going to be the case. It's going to be the refinance side of things that are skewing those numbers. And then here, just going back, if you want to take it back to the 70s again, right? So we're at that 3.55%, nowhere close to the 8.86% and the 12.7s that our parents were buying in, right? 8.12, 6.27, we're still looking good. But what I do want to give a quick example of, right? So if you are in the market to buy a house and you're thinking, should we do it now? Should we wait? I'll give you an example. If you're in the market looking at $350,000 homes, right, and the interest rate, we'll just say is 4%, okay, your principal and interest payment on that $350,000 is going to be around $1,585 a month, okay? Now, if you wait and then that interest rate ticks up to 5%, where some economists are saying we could go. I don't know if we'll be that high by the end of the year, but never say never. So if you're waiting, and then those interest rates tick up to 5%, right? Your principal and interest payment is going to go from around $1,585 up to $1,685, right? So that time to think and to get comfortable could potentially cost you around $100 more a month. Okay, so if you're ready to buy now and you're thinking about it, it's a good time to save that $100. If it's not the right time and you still need to sit with it and process it, it's just to know that's what could happen. You could be spending $100 more. But if now's the right night is not the right time, that $100 might be whatever, but it just has to feel right for you. This is just for your info to help you make a better decision, the best decision for you. Now, I always like this chart, right? So this is the 10-year Treasury yield or 10-year Treasury yield going up, right? That's what it is. But what's fun about this is where the 10-year Treasury yield goes, the 30-year mortgage rate tends to follow. So they're like, what a perfect little pair, right? So we'll keep an eye on the Treasury yield to see where that goes, just to be able to help inform you where the mortgage rates might be going. So a cool little slide, right? So now if we go to Joel Kahn from Mortgage Bankers Association, he's saying, this is going back to refinance, but he's saying mortgage rates hit their highest level since March of 2020, leading to the slowest pace of refinance activity in over 2 years, right? So of course, while the rates are down, everyone's jumping into refinance. Now that we're back up to 3.55%, getting closer to that 3.7% before the pandemic, of course, refinances are going to slow down. That's to be expected. So also, again, if you see any news that gives you a cause of worry or concern that the mortgage industry is slowing down, like there's the home buyers are gone, it's not going to be from the home buyers, it's going to be from the refinance market slowing down. Okay, forbearance, foreclosures, right? So this chart always gets me super excited, like last month, but I'll try to contain myself. Okay, right? So again, here we are in May of 2020 when the forbearance program was thankfully given as an option to homeowners. We had almost 5 million homeowners in the forbearance program, right? So a lot of people. But then you see in January of last year, we've almost cut that number in half. And then here we are, January of this year, where we are sitting below a million, well below a million at 780,000 houses, which is massively, massively awesome, right? So 5 million homeowners were able to take advantage of the forbearance program and have the opportunity to stay in their home. Thank goodness, right? And so now here we are today in January where we're down to less than 800,000, right at 780,000 homeowners who are still in the program but on their way out. And from Black Knight data, Andy Walden. So as the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89%, of single-family homeowners who sought financial assistance through the COVID-related mortgage payment forbearance plans have exited those plans. So that is awesome, to say the least, okay? 89%. And here's a little pie chart to give you a little color and graphic to help break it down again. But you'll see that 38% are paid in full, done, living life. The 43.7% in the blue, they're still in their repayment plans, but will be out soon enough, hopefully. Then you have this 18.2% who are we don't know what they're doing. Maybe they're waiting on the government to call them. Who knows? They don't have a mitigation plan in place. But also for those folks, so those are probably the ones where you're like, those are going to be the foreclosures, the 18.2%. For those folks, as I mentioned in last month's market report, we're so equity heavy right now that if they want to sell their house, if they want to be done and just move on, they do not have to sell it to you for $100,000, for $10. They don't have to do that because they have the equity in their home, right? They can sell it for the value of the house and walk away with money. It's not going to be a foreclosure situation for them because of the how much equity homeowners have in their homes now. So don't wait for foreclosures, okay? Because if you do, you're going to be in that situation where rates were at 4%, you could have bought a house, and now the rates are at 5% and you're paying, $100 more a month. So don't wait for foreclosures. They're not coming. The wave isn't coming. Now, that's not to say there's going to be no foreclosures, right? Because every year there's at least 290,000 foreclosures that hit the market because, of course, you're going to have job loss. You're going to have some catastrophic event that happens in the homeowner's life where foreclosure is just going to be the only option for them, right? So on average, there's about 290,000 homes every year. And you see 2017, 18, and 19 were right around the average. But 2020, we're down to 129,000, right? So not even half, thanks to the forbearance program. In 2021 through the end of the third quarter, we're at 30,000 foreclosures, right? So it's not going to happen. The wave is not coming. And just like a more drastic picture, so you can see in 2008, 9, and 10, like the bubble burst, right? Almost 3 million homes in foreclosure. Here we are in 2021, and we're just not going to get anywhere near those prices. Triple, double, quadruple what our numbers are now, and we're not anywhere near those prices, right? Because homeowners have a lot of equity in their homes, okay? So yes, there will be some foreclosures. There's not going to be a huge wave of foreclosures, so don't wait for that. Okay. From CoreLogic, we may see a little bit of an uptick in foreclosure rates in 2022, just an uptick though, from an extraordinary low level. We're not expecting to see a big increase. We expect delinquency rates overall and home mortgages to actually continue to remain quite low. So just another slide to tell you, don't wait for the foreclosure wave because it's not coming. Okay, so if home buying feels right to you now, while the rates are low, especially with all the craziness going on overseas, now would be a great time to jump into home ownership. So hopefully this helped answer any questions or thoughts that you all might be having on inflation and mortgage rates and foreclosures. But of course, as always, if you have more questions, feel free to drop them down below. Give me a call, message, anytime you have. Anytime a question pops into your head, and I'll be more than glad to help you through that. Also, I have my home buyer and home selling guides coming out on March 4th. So if you need those, if you're thinking about either one, selling and buying, you might be doing both. And don't be scared of that either. I can walk you through that process too. Let me know if you need a buyer or a seller guide, and I can get that to you. But thank you, and I'll catch you on the next one. See ya. Bye.